So Jake, I know that the second quarter is a busy time for the stewardship team, as most of the annual general meetings for companies in US and Europe occur around this time. Can you give us a brief description of what you all are doing in terms of the relation to these meetings?
Sure, Joe. So most publicly listed companies in our portfolio put several items up for a vote at their annual general meeting. Common items of governance include approval of directors, executive compensation plans, and approval of auditors. Other items can be put on the ballot through shareholder proposals. These can either be related to core governance topics, like whether the CEO and chair role should be separated, or specific environmental and social issues that the filer of the proposal feels is material to the company's long-term success. Our team oversees how Wespath votes these proxies in a couple of different ways. The first is through manually voting some of our top holdings, where we read the proxy statement, do third-party research, and discuss internally what vote decision aligns with our fiduciary obligations. For those companies we don't manually vote, we oversee the implementation of custom guidelines through a service provider.
Great, thanks for that explanation, Jake. Given the work you described above, what were some of the broader trends that you saw this proxy season?
One of the key trends we're seeing on this slide, Joe, is lower support across all proposal types. For the last several years, prior to 2022, we were seeing an increasing trend of support for shareholder proposals. However, this year we saw a drop in support for proposals ranging from executive compensation to human capital management.
And what do you think is driving that decline?
There are a few reasons we see commonly cited in the marketplace. One is that large institutional investors are criticizing many proposals for being too prescriptive, meaning that the proposal is too explicit and specific in laying out the action that the investor feels a company should take. Often, large investors prefer to leave questions around specific implementation to the company management or board. However, a recent SEC rule change allowing a broader array of proposals to be filed allowed for more specificity. Some investors think that has led to poorer quality proposals that are more difficult to support. Another reason is that some of the low-hanging fruit proposal targets have largely been covered in previous years, in those trending up support years. For example, with the success of proposals asking for companies to publish basic information on how they are managing climate risk, most companies have adopted some form of disclosure either through the prompting of a proposal or proactively after recognizing that this was an area of interest for many investors. Finally, a large part of the pullback can also be prescribed to a greater level of discernment being applied by large asset managers who drive large percentage of votes at companies. As these asset managers have come under increasing pressure and scrutiny from anti-ESG proponents, it has likely caused them to take a closer look at proposals they may have supported in the past. On the next slide, you also see some of these managers indicating a preference for voting against directors rather than for proposals. It is too early to tell what the impact of this increasing focus on director votes for asset managers will be, but this is a development we are interested in watching and are actively engaging our asset managers on.
And what specific Wespath focus areas or lessons learned are you seeing from this season, Jake?
Well, Joe, to stay on the topic of director accountability for votes, we did pre-declare that we would be voting against 2 directors at Chevron this year. The reason is that these 2 directors were responsible for oversight on how the company aligns their stated commitments on climate with their lobbying and public discourse. We had concerns about the alignment that we brought to the company through private engagement channels. However, we did not see meaningful progress from these conversations, so we decided to take the next step of elevating our concern to a public declaration that we would then share with the broader investor community. While we did not see major swings in support for these 2 directors for this year, we're looking forward to learning from the asset manager and peer investment community how they responded and evaluated this idea. We want to understand more about what investors look at when determining whether to support directors using this example as a specific case study for discussion. We are confident these learnings will help us be more effective in making our case in any similar action down the road.
So besides climate, what were the other areas of focus in this proxy season?
Many viewers have likely heard about our work on opioid accountability. The opioid epidemic remains a key concern for us at Wespath as an obstacle to our goal for helping to support long-term prosperity for all, one of the key pillars of our sustainable economy framework. You can see on this slide some of the economic impacts of this epidemic, with the tragic truth being that the trend lines that we have seen for overdoses cited here for 2020 have shown a significant increase in the last several years. This focus on opioids led us to taking on the co-lead role of the Investors for Opioid and Pharmaceutical Accountability, or IOPA. The IOPA is an investor coalition representing more than $4 trillion in assets under management, focused on engaging and amplifying areas of concern for investors in the pharmaceutical sector through engagement. This proxy season, the IOPA focused on what at first glance seems like a rather dull issue: how companies calculate executive compensation. The reason for this focus is that the IOPA saw many pharma companies excluding hefty legal settlements and fines related to the opioid crisis from their calculations for executive compensation. The IOPA did not believe this practice was aligned with investors' economic interests, since executives were not properly incentivized to avoid mismanagement related to opioid or other regulatory risks. Nor did it align with what Wespath sees as the sustainable economy framework long-term best practice. Through this focus, and despite some of the headwinds ESG proposals were facing this year, the IOPA was able to negotiate withdrawals of the proposals at 5 of 6 companies.
And to clarify, a withdrawal proposal is usually considered a positive development?
Yeah, Joe. Investors will often withdraw their proposals if companies commit to making progress on the issue. This indicates that the company is receptive to the engagement and has indicated that they'll take some kind of action.
That's a great story to end on, Jake. Thank you for being here today, and we look forward to talking next quarter.
Thanks, Joe.